now on to the main program. I'm really excited about this program. No pressure, Andrew. To introduce our program today, Andrew Slimmon is Polly Sidwell, but you should know that Andrew came in from Chicago just for this event, and he is leaving at 3 o'clock. So if you see him scoot out early, that's the reason why. And now from Morgan Stanley, Polly Sidwell, take it away.
I'm noticing that the microphone's going up and down with each speaker. So as a 27-year veteran of Morgan Stanley by way of legacy firm Smith Barney, it's my pleasure to make today's introduction of Andrew Slimmon. Andrew's career demonstrates a similar constancy at one firm, having managed investments at Morgan Stanley since 1991. No wonder, I think of Andrew as earning the mantra of Smith Barney's best remembered advertisement, John Houseman's utterance, "At Smith Barney, we make money the old-fashioned way. We earn it." Andrew is one of 5 members of our Global Investment Committee, which provides guidance on asset allocation and investment strategies to over 6 million Morgan Stanley clients. We believe it's essential that this investment guidance includes thinking from someone with true skin in the game. Andrew's investment decisions are directly embedded and worked into our investment committee, Global Investment Committee's guidance. Notably, this man directly invests for nearly $5 billion, with a B, $5 billion in client assets. To put a finer point on it, Andrew manages stocks for people like you and me and corporations and endowments. You may recognize Andrew as a frequent guest on CNBC to help viewers interpret the ever-changing financial markets. I hope that you are now as excited as I am to hear from our speaker, because he is a sharp observer of the markets. Translation, Andrew is always looking to the future, and he will now share with us what U.S. and global equities may hold for 2015. Andrew Slimmon.
I will move the mic up a little bit. Thank you for having me. And I told my new best friend Ken here, I said, listen, I have 4 kids. I'm taking my kids skiing tomorrow, and if I don't make the flight home, the number one boss you'll have to answer. It's not the boss at Morgan Stanley. So, but thanks for having me. About 2 years ago, I spoke at a Rotary Club. It wasn't the number one Rotary Club in the country, in Honolulu, and I was reminded by Leslie Delaney, who's here on our part of our portfolio team, that some of the slides that we used a couple of years ago are still on the deck. And the bad news is they're repetitive. The good news is they're in the deck because they've been right. And I think what Polly was very nice in introducing is I'm not actually a strategist. You're not hearing someone wax about what they think will happen to the market. I'm actually a portfolio manager who actually has to be right, or hopefully is right. And so what I'm going to talk to you today is a little bit about the markets, and the argument I'm going to make to you is that what has happened in this bull market since 2009 is really not that unusual. And it's been very predictable of what's happened. Unfortunately, because it's been predictable, it doesn't necessarily sound as eloquent and sells books as being something different, but this is what's really happened. And I want to start with just a couple quotes. So let's see if we can turn the page here. There's a quote, I realize this is small, there's a quote, I'm going to read you 2 quotes, and they seemingly differ tremendously, but it really tells a very good story about investing. The first one is from Sir John Templeton on page 5 of the presentation. Bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. Sir John Templeton, 1966. So in other words, what he's saying is just at the time when no one wants to invest, that's the best time to invest. Inevitably, when everyone wants to invest, that's when investments get difficult. The other quote I want to read was from another strategist a couple decades later, Jason Zweig. He wrote, "From financial history and from my own experience, I long ago concluded that regression to the mean is the most powerful law in financial physics. Periods of above average performance are inevitably followed by below average returns, and bad times inevitably set the stage for surprisingly good performance. So what is the difference between those two quotes? The first quote by Sir John Templeton is a human behavior quote. Basically what he is saying is that we all suffer from something called recency bias. Anyone heard that term, recency bias? As humans, we tend to put more emphasis on our experience that have happened to us recently than the long-term data. So this bull market started on March 9th of 2009. We were in the middle of a recession. But stocks look forward. They don't look backwards, right? And so the return recently of the stock market had been very, very bad. And remember that second quote I said to you, invariably bad times are followed by good times because of reversion to the mean. So it was right at the middle of a bear market that stocks start to rally. And in fact, it's very historical. Most bull markets start about 6 months before recessions end. The recession ended in September of 2009. The stock market bottomed in March of 2009. Right on cue. Unfortunately, because we look back to make our decisions not looking forward, we're very bearish at that point. So that's why this chart is a chart that I've been using now since 2009, but all I've done every year, and you can see there's different X's for different parts of the world, but that little red X is the United States, and every year I've just moved that X up a little bit. So said another way, at the bottom, we have contempt for stocks. The stock market's nothing more than a Vegas casino. And at the top, we have clients calling up saying, I'm not greedy, I just want 15 to 20% returns a year. But inevitably, the contempt is right after periods of very bad losses, and the greed is after periods of tremendously good returns. Those comments, I'm not greedy, I just want 15 to 20% returns, that was from the late 90s. The decade of the 90s, does anyone know the annualized return of the stock market in the 90s? 19.5% a year. Expectations were wildly above the realities of the long term. Our recency bias, our recent experience suggested very big returns. And yet this long-term return of the stock market is only about 9%. So does anyone know the return in the first decade of the 2000s? 0. So what made, if we had 19.5% for the first 10 years and 0 the second and the next 10 years, what was the 20-year return? 9.5%. Reversion to the mean. But fortunately, right at the late 90s, because our expectations are so above the long-term return, no one was investing in 1999-2000 to make a 0% return. Right? The flip side is you get to 2008, and now the returns are so subpar that was actually a very good time, 2009, to invest coming out of recession, because the recent returns had been so inferior to the long-term returns, but we're unwilling to invest because we have this emotional attachment to the recent experience. And that's why that quote by Sir John Templeton is so relevant. So the question is, where are we in the cycle? Are we back to greed? You know, we can debate Andrew, where is your X? Where is the right place for the X? And what's fascinating is the structure and the way this market has rallied since 2009 is also very consistent with history. So the first leg of the bull market, see that first arrow that says earnings driven? Two things drive stocks, right? We all know this. It is the underlying earnings of the companies that people invested in, plus what is the multiple, how much are you willing to pay for those earnings? That's what drives it. Well, fundamentals of the company drives the earnings, sentiment drives the multiple. But in the early parts of a bull market, sentiment is really bad. So you have no PE expansion. no multiple, no people aren't willing to pay ever higher prices for those stocks. And therefore, the only thing that lifts stocks is earnings. And so from 2009 until 2012, the S&P, the earnings of the S&P doubled. And how much do you think the stock market was up? Double. But ultimately, you get to a point where people said, oh, recency bias, now the market's gone up from 3 or 4 years. I don't remember the pains of 2008 as much. And they start to invest. And so this is exactly where we are now. We're into the second stage of a bull market where you start to get PE expansion. And so are we back to the stage of the late 90s? Polly, you tell me, are your clients calling up saying, I just want 15 to 20% a year? We're not seeing it yet. This chart is a chart of Gallup polls. And they interview thousands and thousands of investors, and they say, are you optimistic or are you pessimistic? And so where I wrote greed, that was the late 90s. That was the late 90s. Very high levels of optimism. Why? Because the market had just gone up 19% a year. In 2008, very, very low levels of optimism. Why? Because the market had just dropped. And so you can see that we're back. We've come back somewhat, but we're certainly not at the levels that we were in previous peaks of bull markets. Last summer, Gallup poll, now let me back up. In 2013, the S&P was up 32%. Last summer, in the summer of 2014, Gallup went to 5,000 retail investors all around the country that they knew had some investment in an equity mutual fund. And they said, they asked one question. They said, how much was the S&P up last year? Now, I told you it was up 32%. 70% of the respondents said less than 10%. Okay? That, to me, is such an indication of human behavior, because at the end of bull markets, people would have said 32.324%. But they didn't know, because that is a sign of we're still in the process of getting back to those higher levels. I think one of the things that people ask us all the time is, well, when's the next correction? I want to wait for the next correction. I don't want to invest if we're going to have a pullback. I believe it is a waste of time to discuss corrections within a bull market, because almost virtually all big corrections, the 20% plus corrections, surround recessions. So we're going to have 10, 15% corrections along the way in a bull market, but I really question whether you think you can get out, sell your stocks, get back in down 15% and make money. Uncle Sam will love you to do that, right? You generate a lot of capital gains, but the reality is no one sells at top. It's only after the market drops 5 to 10%. And then when it goes down 15%, you don't want to get back in because it's going down 20. Except every time it's been down 20, with only 3 exceptions. 16 times in the last 85 years, we've had 20% corrections. 13 of them have been caused by recessions. So the number one thing is, unless you think there's a recession looming out there, there's a very high likelihood we'll get 10% volatility, but the market's going up. There's only been 3 times where we've had 20% corrections that weren't caused by recessions. 1961 was the Cuban Missile Crisis, 1966 Vietnam War, and 1987 we had this portfolio insurance that was supposed to protect everyone on the downside, except it didn't. And we didn't have a recession in 87, so the market came back very quickly. But the point is that what people fail to remember, which is on this page, is what drives stocks ultimately is earnings. It is earnings. Look at that line. That blue line and that red line is stock prices and earnings. It is not necessarily the day-to-day news. And as long as earnings are going up for companies, the stock market will continue to rise. we don't see a recession out there because ultimately to have a recession, you need to have an economy that's grown at a substantial rate so you have an asset bubble that bursts. A simple rule of thumb is roughly about remember I said about 6 months before the end of recession, the stock market will sniff out and start to rally. About 6 months before a recession, the stock market will start to sniff that out. We don't see a recession out there at least for another 3 to 4 years. Okay? So I think you've got time here in stocks. And one of the arguments against a bull market is always, well, the stock market's expensive based on trailing earnings. Now, let me ask something. Anyone that's bought Apple stock, does anyone own Apple stock in here? Okay. If you bought it today, were you buying it because they sold the iPhone 2 really well? Or are you buying it because you think they're going to sell more of the iPhone 6, you like the watch, you think they're going to have some more products? You're looking forward. You're buying the stock because you think in the future will hold well for Apple. Said in other ways, stock prices are the present value of what's going to happen, what people think are in the future. And so why stock markets die on euphoria is because the expectation of the future gets too high. So when you think about buying, investing, it is all about what is going to happen in the future, not what's happened in the past. And for that reason, we look at what does the market expect. So the market today expects earnings that will equal about a PE for 2015, about 16 times earnings. So every time you hear someone say, well, the Shiller PE that looks back the last 10 years is expensive, just remember that's what I said, which is no one is buying Apple stock because of what happened 7 years ago. It is all about the future. So think about the future and what is embedded in stock prices today. And the reason why the market bottomed in the middle of the recession was there was very low expectations. And then slowly the economy started to pick up and things got a little better than people expected. Stocks rally. In 2001, Cisco Systems dropped 20% one day. It was the day they reported 30% earnings growth. Great earnings, except they were supposed to report 35% earnings growth. And the stock was trading at 100 times earnings. So this is what's important to consider, what is expected versus reality. And so we don't think, as the chart on the left, at 16 times earnings, the market is particularly expensive relative to where it's been in other parts in other bull markets. Unfortunately, because of that recency bias, the data suggests that most people haven't exactly traded or invested correctly. This is a chart that shows the fund flows that go in and out of equities. So it's a monthly flow chart. Now, so when the blue line is facing down, it says that people pulled from equities that month. And when the blue line is going up, it means that people were invested. Now, remember I told you the market bottomed in March of 2009 at the S&P at 650. What is it today, 2075? So it's up 3x times. What were people doing that month in March of 2009? Selling. And look at all the selling that went on until basically the end of 2012. Why? Because of recency bias. They remember the pains of the big bear market. Even though the economy was coming out of recession, we're still too busy looking backwards, even though the stock market's looking forward. So tragically, people were selling just at the time they were to buy. And so this is why it leads me to move the X up, because you can see now fund flows have turned positive. People's expectations are starting to grow. And this is why we have a few more years of a bull market, but it's not nearly as attractive as it's been looking back. Does anyone know the 3-year annualized return of the S&P? So what's the S&P annualized last 3 years? 20%. Remember I told you, 9% on average versus 20%. So I think this is the issue. The other kind of sad commentary is I don't think 24-hour business instant access to news, the ability to click on your account every day is necessarily helping investors. This is a study that was done by a business school that was in the Wall Street Journal last summer. And they took all the trades from a firm, it wasn't Morgan Stanley, but it was a firm on Wall Street, of all, whenever someone called in, a client called in and bought or sold an ETF, which is the market. And they accumulated all the purchases, which is the light blue, and they looked at all the sales, which was the dark blue. So whenever someone bought, how did those buys do over the next month, 6 months, and going forward? And then they compared that to the sales. And so the dark blue is the sales, and on average, the sales went up after people sold, and the light blue is the buys, which inevitably went down and really trailed. And so this chart is not to highlight the poor trading, I guess it is, but what I'm trying to highlight is what is apparent to me and us is that we have forgotten what drives stocks is earnings and what is going on in corporate America. And it is not about what's being reported every day. I was on CNBC last summer, the day that Air Cantor lost the primary, remember, in Virginia, and they said to me, well, Andrew, markets, what do you think about the market, this Air Cantor move, loss? I said, I think it's a colossal waste of time to talk about politics as it pertains to stock market. We waste way too much time. The reality of this previous page is what drove investors' decisions was more to do with what was going on in Washington, D.C., than watching what was going on in corporate America. A very simple question that you could all ask me is, Andrew, how come the market went up by 100% from 2009 to 2012 if everyone was selling? Which clearly you can tell. Because individuals were selling. Institutions were selling. But what were corporations do? They were buying back their stock. So every dollar that all of us were selling cumulatively, corporations were buying back. Why? Because during the recession, they had tightened their belt. We're coming out of recession. We have very strong margins. We're generating excess cash flow. Are they going to hire more people? Nope. Are they going to build more plants? Nope. Are they going to make mergers, acquisitions? Nope. They're going to buy back stock, raise dividend. So corporations were buying back their stock, but because we're so busy watching the news and watching everything that happens in Washington, we're largely missing out. And that's kind of the tragic story of this bull market. Just a couple of short-term things I think is relevant. You've probably heard this headline, stocks weak, over the last month or so. Stocks weak because of weak energy prices. Excuse me? Stocks weak because of weak energy prices? Last time I checked, unless we are in Texas or in the Dakotas, for most of us, weak oil is a good thing, not a bad thing. And so this is just a little gentle reminder that it looks at the history of when oil has dropped as much as it has. And there are periods during recessions where we have had big declines. But if you just look at other periods when the economy was okay and we had big declines, what you see is the stock market has done very well during those periods, on average about 23%. So again, don't let the headlines scare you away. Most companies will benefit from weaker oil because oil is an important input into production. All of us are going to have a few extra dollars to spend because it won't cost us as much to fill up our tanks. So that's incrementally positive for the stock market. This is such a busy slide. Ken would tell me, Andrew, what did you do keeping this slide in there? So I'm just going to explain this slide to you. So I do think there is one thing that could happen this year that will cause a pause in the stock market. And that is that the Federal Reserve is discussing raising rates because the dual mandate of the Fed is fight unemployment and control inflation. And as the economy accelerates, there is more of a concern in controlling inflation. And so there's a likelihood that the Fed will at some point begin to raise rates off these very low rates. And again, looking back at history, is when the Fed changes policy, it tends to cause what I call a timeout in stocks. Now remember last year we had something called tapering? Remember what tapering was? The Fed had been buying $80 billion of mortgages a month to help keep rates low to stimulate the housing market. And they announced at the end of 2013, well, we can stop buying as many bonds, but we're not going to go from 80 billion a month to zero. We're going to reduce it over time. And so from beginning of January until early October, we're going to buy a few less bonds every month till October. We'll be out of the bond buying business. That was a change in policy, right? Because it was an acknowledgement that they didn't need to help the economy the way they were. How did the stock market do from the beginning of January until the day they said that they're done tapering? The stock market was flat. It only rallied after they were done with tapering. And so I think what you'll see is if they raise rates, you'll get this anxiety, you'll get a lot of press, oh, they're beginning to raise rates, the end is near for the economy. It is not. This is a pause in a bull market, but this is the headlines that are out there, and I think that's what we will see this year. Moving to international investments, global investments, and we run global portfolios, so we really trying to find great ideas around the world. I really think about stocks, and hopefully this has become apparent to you. There's really three main drivers, which is central bank policy, earnings, and multiples. Remember the number one saying, one of the most simplistic investment truisms, don't fight the Fed? Has anyone heard that saying, don't fight the Fed? Which means when the Fed is accommodative, you buy stocks, and when they start to restrict, that's when you get a little bit more cautious. And the fact is that they rolled out their first quantitative program at the end of 2008. And if all you did at the beginning of 2009, you said, I'm not going to watch TV, I'm not going to listen to all these strategies, I just know don't fight the Fed, I go long equities, that's it. It's been a great trade. It's been the right thing to do. Don't listen to all this volatility. The Fed, as long as the Fed has been accommodative, you stay long equities. That's worked. But obviously they're going to begin to change policy, and again, I don't think this is the end, but that's a question mark of when that's going to happen. And if it happens early this year, I think that will cause a pause in the market. If it doesn't happen until next year, we could have another pretty good year. For earnings for the S&P, we have a lot of changes going on because on the one hand, lower oil is helping consumer stocks. It is helping manufacturing, but we've had a stronger dollar. And that's starting to cause some headwinds for some of our very big multinational companies. So earnings growth is starting to moderate a bit. But I don't think the P expansion story is over. Again, we're about 16 times earnings. Ultimately, at the tail end of bull markets, you get multiples much higher than that. I think that will continue, especially in an environment where fixed income and interest rates where they are really are not an attractive alternative. There's something called the dividend discount model that looks at the fair value of stocks relative to bonds, and where bonds are today. If I was talking about the dividend discount model, I'd tell you that the market should be trading at about 25 times earnings. So I think that's way too optimistic. All I'm saying is maybe mid-teens multiple a little bit too low. Europe and Japan, on the other hand, they have central bank policy that's very accommodative, and they won't be changing policy anytime soon. But for Europe, what Europe has suffered from is very little earnings growth. And that's because the euro was so high relative to the dollar until last summer. And as the euro has started to come down, this is a chart that shows the dollar versus the yen and the euro, what has happened? European companies have started to announce better earnings. It was in the paper yesterday that Germany just had the largest trade surplus in their history and their highest exports ever. Okay, so big export companies out of Europe are starting to benefit from the weaker euro just at the time that we are we're hitting some headwinds. Japan, again, same benefit of central bank policy. Their companies are benefiting also, but Japan's been in a 20-year bear market. A lot of recency bias there. And so multiples need to expand. A little more optimism, but I think a lot of these autos and electronics companies, they will report very, very good quarters, and you'll start to see more interest in those types of stocks. What we know for sure, and this is fascinating, is that when you talk about international to anyone, it's tough to get them interested in investing outside the U.S. And why is that? Recency bias. So from 2001 through 2007, the market compounded, the U.S. market underperformed the rest of the world by 74%. So international investing was much more popular than the S&P. And since that point, so that was 7 years, 70% outperformance. Since that time, the S&P 7 years of outperformance by 70%. So we've had a complete mirror shift. And so for us, it looks like there's more opportunities outside the United States, but it's painful to do because of those experiences recently where it hasn't been as good a place to invest. So how's that? Was I right on time? I'll skip the conclusion, so we'll have a couple minutes of questions. Is that all right? Or you want? Okay. Ken tells me I can give the conclusions. He is the boss, as far as I can tell. So just the conclusions. Look, I think in terms of the markets overall, I think that every strategist on Wall Street thinks the market's going to be up 8 to 10%. Have you ever heard a strategist doesn't think the market's going to be up to 8 to 10%? They all are. But what's fascinating, the market's up about 9% on average. But if you go back and look at the number of times the market's up 9%, it's rarely happens. So I think the market will be up this year. I don't think it'll be much if the Fed raises rates soon. It'll be up a lot more if the Fed waits till next year. Simple. But the fact is, this is a pause, not the end of a bull market. And I think that's the point. The last point I would make is that in the late 90s, people paid exorbitant multiples for technology stocks, healthcare stocks, because they were growth stocks. And they paid nothing for dividend-yielding stocks. So the technology sector traded at 50 times earnings, the S&P was at 30 times earnings, and the utility sector was at 8 times earnings. 6 to 8% dividend yields in utilities. Today, the technology sector trades at 15 times earnings, the S&P is at 16 times earnings, and the electric utility sector is at 17 times earnings for a group that barely is growing. So the point is that in the late 90s, after a big bull market, people want stocks that can appreciate, big returns. And yet that was a great time to be buying dividend-yielding stocks. Today, because of low rates, a lot of people want dividend yields. I get that, except you're telling me that Google and Apple trade at lower multiples than the electric utility industry? That's crazy, and that's because of our human behavior. So, Q&A, questions. Thank you. Yes, sir.
Nicole.
Thanks so much. I used to work in this industry, so all these charts are bringing back lots of memories. For those of us who are small business or solopreneurs who really manage all of our own retirement investments, one of the things you said was that active investing doesn't necessarily give us that much, and emotions can get in the way. What is your best advice for somebody for what they should do with their own nest egg if they're managing their own investments and just want to have a solid portfolio that they're going to let sit for the next 25 years or before they really have to get involved in thinking about getting money out for retirement?
So I'll tell you a story. A very dear friend of mine, he's a pediatrician. He's a behavioral pediatrician. He wears the bow ties like Mr. Rogers. And he got a job at the University of Chicago Hospital in 2006, and he came to me and said, I don't know anything about investing, but I got this 401k, and I got to allocate money, and I just don't want to deal with it. And then this is 2006. And I said, Larry, you're not retiring for a long time. I think you should put a third in small cap, a third international, a third in large cap stocks. He said, okay. And I said, but you got to promise me one thing. you're not going to open the envelope for 5 years. So he came to me in 2011 and said, Andrew, I just want you to know, I haven't opened the envelope for 5 years. I said, you are the #1 investor at the hospital. Because if you'd opened the envelope in 2009, you would have sold everything, right? And so the point is, equities will give you the best return over time, but with a lot of volatility. Unfortunately, as I've proven, hopefully shown, investors don't make the right, they lose their nerve at the wrong time. And so this is why fixed income and having some bonds are so important, so that you can ride out that volatility. What we know statistically from our client base is those clients that had a bond portfolio in 2008 were more likely to actually hold on to their equities than those that had a lot in equities. So I do think diversification allows you to capture those long-term returns. There's no question in my mind equities will be the best investment, but it will come with a lot of volatility, and can you withstand that volatility?
Anne Marie has a question.
Yes.
Hi, I heard you say not to watch politics when you're watching the stock market. I also heard you talk about the European Central Bank. And I wondered if the recent Greece elections and the dissonance between Greece and Germany has anything to do with your perspective on the euro. Thanks.
I really did not set her up for this question. So Greece became an independent country, and I hope I'm not insulting anyone here, but Greece became an independent country in 1828. Since that time, they have defaulted on their debt 5 times. They have been in debt restructuring mode over 50% of the time since they went independent. This is not unusual. And yet the equity market, we don't have data that goes back to 1826, but we have data that goes back 100 years. The European equities have compounded about 9% a year. Now, if something happens, Greece, it will be all over the headlines. The market will pull back 3 to 5%. It's not going to have a material impact on long-term returns. So I think it has a short-term, and these 24-hour business got to report on things, but I don't think it will have a long-term impact. And said another way, when things are going great, you should bet they won't, and when things are going really badly, they probably restructure their way out. So look, I'm a professional investor. I have no idea what's going to happen geopolitically. I sit on our global investment committee. We have tons and tons of these oil guys. No one told me that the oil was going to drop 50%. No one told me that Russia was going to invade Crimea. So I think it's a complete waste of time to try to predict geopolitical events. But what I know with very high certainty is how all of us are going to react at every juncture. Because it's the repetitiveness of human nature that as professional investors, that's what we're really capitalizing on. And 24-hour business and instant access is causing behaviors actually to get worse, not better. Fortunately for us, that's good, because we'll say, gosh, oil's down 50%. I know that's a time I should be buying oil stocks, even though everyone's saying they should sell. Greece, if that caused a pullback in Europe, I don't think that's going to materially change the export power coming out of Germany. I'm going to increase exposure there. So, yes.
Bill has a question.
Yes.
Someone said, without data, when you speak, it's just another opinion. So thank you for being so data-focused and bringing us more data than bringing us your opinions. But one set of data that is concerning is that those of us who have stocks have done quite well, but workers' income has not increased. Is that going to be a problem in our economy that will affect stock prices eventually and earnings?
So, yes. So there was a book written in 2008 called This Time is Different. It's by Carmen Reinhardt, and it looked at the history of when you have recessions caused by banking crisis. And they wrote this book in 2008, and they came to the conclusion that all recessions caused by banking crisis, the trajectory coming out of out of that recession, you usually have 5 to 7 years of virtually no economic growth, very low growth. And it's only after that period, because it takes so much deleveraging, the economy starts to accelerate. So what that means for corporate America is that they haven't really materially had to change their infrastructure to to sell their products, right? So we've had very marginal top-line revenue growth, but excess cash flow has been returned to shareholders through the form of stock buybacks and dividends. So it's been very beneficial for shareholders, but there's been no incentive by companies to raise wages, hire more people, and so forth, because they're not seeing the top-line growth yet. But my suspicion is, as the economy starts to accelerate, if I'm a CEO and I'm worried about, I got to sell so many widgets, I start to worry I don't have enough infrastructure in place to sell my widgets. That's when I start paying people more and start hiring people. So we need the economy to accelerate. And once the economy starts to accelerate, there's going to be ultimately what I would call a transfer of excess cash flow from the shareholder to the employee. So the most important thing that should come out of Washington, D.C. is a way to accelerate the economy, because then people start paying their employees more. And in this stagnant environment, don't need to.
Lou has a question right in front.
Your mark suggests there may be opportunity in foreign markets, but if you hedge the currency risk, how do you feel?
So the dollar has gone up a lot versus other currencies, but we invest all around the world, and we don't hedge our currency. And we don't hedge our currency because, remember I told you that first quote, reversion of the mean, most powerful tool, which means inevitably when currencies go up a lot, they tend to turn around and go back down. Said another way, whenever people ask me about hedging the currency, it usually means the currency's already appreciated. I don't know anyone that's really, Warren Buffett, great equity investor, Bill Gross, great fixed income investor. I don't know anyone that's been a great currency investor. I know people have traded currency successfully. So I'm very dubious about making currency bets. And by hedging, you're ultimately making currency bets. Our clients are dollar denominated. Maybe we won't make as much because the yen will drop and we own some Toyota Motors, but over time, Toyota will sell more cars because of that weaker yen. So it evens out over time. There's just not enough data to suggest that we should hedge the currency. And hedging costs us money. And therefore, my investors, it costs them money. I'm interested in maximizing our return for our investors. And if I have to pay someone else to hedge a currency, I just haven't seen enough data to say I should do that over time. Thank you very much for having us.
Let's have a big hand for Andrew. He came here today between ski sessions, so another big hand for Andrew.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health.